In the world of finance, Jim Cramer has become synonymous with bad calls and market predictions. As the host of the popular CNBC TV show Mad Money, Cramer has gained a significant following of both eager investors and curious viewers. But not for the reasons you think. Investors are now trading against Cramer's market picks, and there's even an inverse Cramer ETF mirroring Cramer's pick in the opposite direction. Today, we delve into the history of Jim Cramer's notable bad calls and introduce the concept of the inverse Cramer ETF ticker SJIM. So on that note, who is Jim Cramer? James Joseph Cramer graduated with honors from Harvard University and Harvard Law School. After graduating, Cramer found himself on the bustling trading floor of one of Wall Street's most prestigious investment banks, Goldman Sachs. However, his ambitions didn't end there. In 1987, Jim Cramer decided to forge his own path and founded his hedge fund, Cramer & Co. This move marked the beginning of a new chapter in his career, where he would showcase the investment expertise he had picked up from the trading floor. Managing Cramer & Co. from 1988 to 2000, he claimed impressive achievements, boasting average yearly returns of 24%. During this period, Cramer says he took home a staggering $10 million or more each year, a claim that drew both admiration and skepticism. Meanwhile, Cramer's charismatic personality and financial acumen caught the attention of CNBC, a leading financial news network. By the 1990s, he started appearing as a guest correspondent on the channel, leveraging his knowledge and experience to offer insights to viewers. With his background in journalism from his Harvard days, it was no surprise that Cramer found himself in the spotlight of financial television. In 2002, he co-hosted the CNBC show Kudlow and Cramer, with Larry Kudlow further solidifying his presence on TV. Then came the show that would make him a household name, Mad Money with Jim Cramer. Since its premiere in 2005, Cramer has captivated audiences with his energetic delivery, stock picks, and advice on do-it-yourself investing. But one factor that has brought Cramer constantly to the spotlight is his consistent bad calls. As the host of an investment TV show and experienced as a hedge fund owner, it's really a wonder why Cramer is consistently wrong in his predictions. Let's start with spring 2008. On the show, Cramer advises viewers to keep holding Bear Stearns. However, in less than a week, Bear Stearns fell 90%, requiring a bailout at a measly $2 per share. This unexpected turn of events left many investors shocked and questioning Cramer's judgment. But it doesn't end there. Fast forward to March 2022, when Cramer declared that the bear market was over. Unfortunately, his proclamation was followed by a 70% drop in the Nasdaq, an 11% decrease in the S&P 500, and an increase in interest rates. In another instance, Cramer expressed optimism about Ethereum, suggesting it could gain 35 to 40%. Shortly after his statement, the price of Ethereum, which was around 310 at the time, went down. Now, let's talk about Cramer's Magnificent 7 stocks, which he claimed investors should keep buying regardless of their underlying value or market conditions. Out of these 7 stocks, 6 have since performed poorly, leaving only Tesla as the remaining survivor. Netflix went down 61%, Zoom 65%, Peloton 83%, Roku 70%, Square 60%, and PayPal 68%. Cramer's Twitter predictions are also far from accurate. In February 2022, Cramer tweeted support for Upstart and Airbnb. Since his endorsement, Upstart has dropped 80% and Airbnb's value has decreased by 40%. Cramer endorsed Coinbase before its public offering, predicting a price of $475. However, after Coinbase's IPO, the stock declined by almost 80%. And it's not just his buy calls that go sideways. In yet another instance, Cramer advised against buying Caravan when it was priced at $4.55, only to witness the stock grow by 100% in just a month. And if you thought at least he got the Tesla prediction earlier, Cramer still found a way to fumble the bag. In early January, Cramer tweeted that Tesla was not a buy. Contrary to his statement, the stock went up by 66% by the end of the month, leaving investors questioning Cramer's judgment once again. Cramer tweeted on January 9th, "Good chance again to get out of crypto and scale out of Chinese stocks as neither can be trusted." Following Cramer's tweet, Bitcoin went up over 40%. On Meta, Cramer couldn't be more wrong. He initially declared the company a buy, but by October, Cramer appeared on TV apologizing for being wrong on his buy call. Ironically, after the interview, Meta stock price skyrocketed by 85%. And if he failed to predict one run on the banks, Why not another? Lastly, we have Cramer's call to buy Silicon Valley Bank stock, claiming the stock was still cheap. Unfortunately, shortly after his endorsement, the bank failed, marking the second time Cramer's buy recommendation preceded a run on the banks. The inverse Cramer ETF. The ETF industry is not shy about jumping on pop culture trends. Take, for example, AXS, Short Innovation Daily ETF, SARK, which shorts Cathie Wood's ARK Innovation ETF, ARKK. And it's the same for Cramer. In a poll done by Market Mood, if you had followed Cramer's pick from August until now, you would have experienced a staggering 83% cumulative return on a $1,000 investment. Cramer's average 2-week return on his pick was -4%, while his bullish picks performed slightly better at -2.7%. His bearish picks struggled with a -6.9% return. This logic is the bedrock for the Inverse Cramer Tracker ETF. According to the prospectus, the funds aim to engage in transactions designed to perform the opposite of the return of the investments recommended by Jim Cramer. However, the specific criteria for identifying these stock picks and executing the trades may seem rather vague. The fund intends to short sell stocks that Cramer recommends buying on air or on Twitter. While it's not clear how quickly these trades are executed, the plan is to hold these positions for approximately 5 trading days, with the option to extend if Cramer continues to express an opinion. If a buy call becomes stale, the fund has the discretion to liquidate the position. The number of positions held will generally range from 20 to 50, but the selection process lacks specific details. The launch of the Inverse Cramer Tracker ETF certainly presents an interesting opportunity for investors. However, it's crucial to note that an inverse fund may not be suitable for long-term holdings. Instead, it's more appropriate for those who want to take short-term positions and carefully manage the risk. But what's the future for the Inverse Cramer ETF? Do you think it's worth investing in? Let us know what you think in the comment section. If you enjoyed this video, be sure to smash that like button, subscribe, and share it with your friends. As always, don't miss our next video. Thanks for sticking around, and we'll see you next time with more thrilling stock talk from Stock Dork, your top source for the most exciting stock market trends and investment opportunities across the internet.